Welcome back to the Realty One Stop YouTube channel. Today we are going to be covering part two of our vocab that you must know if you're going to get into real estate investing. We have 17 or 18 more terms to cover. We covered 34 in part one. If you haven't seen it, go check it out. Again, if you guys like these videos, please leave me comments, questions you may have about real estate investing, and of course, like and subscribe. Starting off where we left off, number 35, we're going to talk about cap rate. Cap rate is a term you may hear, especially if you're in commercial real estate investing. And it's basically a percentage of the market's expectation of return on any given asset. So this is typically going to cover commercial properties, commercial multifamily, meaning 5+ units. And it's going to be based on a cash purchase price. So it doesn't account for debt service because obviously that's variable. So they are looking at the current income, the actual performing income, and the current actual expenses. That's going to give you a cap rate. Now, the way cap rates are usually determined on a market basis is by other sales. So similar to residential sale comps, which we'll cover, this is going to be a estimation of expected return based on comparable sales of commercial real estate. So, for example, let's say there's a 20-unit building that's sold in Cincinnati, and based on the net operating income that we talked about in the last video, if you take the net operating income divided by the market cap rate, that should give you an approximated value for that property. If you reverse engineer that, you can take the sold price of a property multiplied by a cap rate factor, and that should give you the net operating income. So this formula kind of works, in all three ways. Now, I don't want to get overly complicated. I know this may be hard to imagine if you're just listening to this or watching this video. It's probably hard to visualize without seeing the math on paper. But the main thing I want you to take away from this without getting overly complicated is that generally cap rates are going to be used to evaluate properties when you're trying to purchase them or refinance them. Okay, so it's basically an expectation of return based on a cash purchase price. And again, using commercial real estate, 5+ units. If you have questions about cap rates or anything to add, of course, leave me a comment. I'd love to chat about it more. Number 36 is comps. So like we just mentioned, comparable sales. This is something that if you've ever bought a home or sold a home, a residential home, or even a 1 to 4 unit apartment building, you are going to be dealing with comps. So you'll hear agents talk about it, brokers, buyers, sellers. It's simply comparable sales, meaning that on my street, there's 4-bed, 2-bath, bi-level houses. If 2 of them sold down the street for a similar price, that's an expectation of value based on mine. Now, of course, there's variables that go into comparable sales like level of finish, the quality of the property, and the amenities that were added, of course, square footage and things like that. But in general, like homes that are sold in neighborhoods of close proximity are going to give you reliable estimations of value based on comparable sales. Again, those are sold properties, not ones on the market, not ones that might be listed, ones that have sold in the last 6 to 12 months typically. Valuations, that's basically what we're talking about here, okay? This is number 37, valuations. This is different ways that people determine the value of properties, okay? So the big three are comparable sales, income approach, meaning that we look at a value based on how much income it will spit off as for an investment property, or they look at the replacement cost. So you'll see this a lot on appraisals. So just because the market value of an apartment building may be $500,000, if the appraiser determines that, hey, in 2022 cost to replace this property is actually going to be $750,000, it could have a higher replacement value. You'll also see this on your insurance coverage. A lot of times, if you have a loan on a property, your lender is going to want a full replacement policy in place. That way, if your building burns down, your lender's not out the money. Therefore, your insurance company is going to have to cover it based on replacement value. So if you're talking about different ways to do valuations, those are the three most common. Again, you'll see those on appraisals. Rent comps, just like sales comps. Number 38, rent comps. This is simply a way to estimate the market rent for a property or for an apartment based on similar properties in the neighborhood. Again, you're going to look at websites. So personally, what I do to come up with rent comps is I look at Zillow rentals, I look at apartments.com. You can look at Rentometer. That's kind of like a conglomerate of all those other factors, but I found it not to be as accurate. I'd rather go out and find actual properties for rent or that have recently rented that are very similar to mine in amenity and size or lower quality to give myself an accurate estimation of what I can expect for market rents if I were to buy a property. 39, tenant screening. This should be pretty common sense, but it's the act of screening your tenants effectively using third-party services to do background checks, eviction checks, credit checks, and it's going to give you a good idea of the quality of that tenant who's applying for your house or apartment. So I would highly recommend doing this. If you're going to be a professional landlord, you need to have solid tenants and you want to get the best tenants you can, and the best way to do that is by doing background checks and screening. You can also get references you can call. You can get their proof of income, pay stubs, and you can also, check their ID, make sure that their driver's license or ID matches the application and information they're submitting to you. That's tenant screening. Number 40, tenant proofing. This is a concept. I don't know who actually came up with it. I've been saying it and doing it for years, but tenant proofing is when you're renovating your properties in a systematic way to help make them not only desirable for tenants, but very durable against tenants. So when I first started getting into landlording, I was using tile, and now I've switched to almost all luxury vinyl plank flooring because it's scratch resistant, it's water resistant. I allow pets in my apartment, so they're very durable for pet scratches. I used to use hardwoods that would always get beat up and have to get replaced. I don't do any carpet in any of my rentals anywhere because every time I do carpet, or had in the past, or a previous owner had carpet, it had to be replaced after each tenant lived in it. So when I say tenant proofing, I'm talking about making your apartment not only desirable, but durable. So real tile showers, real tile backsplashes, granite countertops if it fits in your market. These are things that are going to hold up on the wear and tear of tenants. Also using like real brass plumbing fixtures instead of using like chrome plastic ones that are going to break and you're going to have to replace them every 6 months. These are things you can do to tenant proof your rentals. 41, economies of scale. When we talk about economies of scale, this is a term that's used often when you're referring to doing multifamily versus single family. So for example, if you have a 100-unit apartment complex, you're going to get a massive economies of scale versus buying 100 single families. That's even magnified further where if you're 100 single families were, let's say, spread all over Ohio where I'm based, then you're going to have zero efficiency when it comes to management, maintenance, and simply the cost of renovations. If you have 100 units under one roof or 5 roofs, let's say, your cost of replacing your roofs is going to be significantly lower than if you had 100 single family homes where you had to replace 100 roofs. So, you're talking about tens or hundreds of thousands of dollars in cost savings for the same amount of doors. So when we say economies of scale, that's what we're talking about. Building efficiencies through renovations, management, by having a large amount of units either in close proximity or, even better, on one property. 42, long distance investing. Basically what it, sounds like what it is. It's when you're buying real estate in a market that is not where you're local to or is so far that you could not self-manage it or drive there. So, if you're buying properties an hour away, you're not really long distance real estate investing because you could technically self-manage. You could go visit those properties if needed. So when we talk about long distance real estate investing, you're talking about buying multiple hours away. You have to fly to get there. You have to drive for days out of the country, out of the state. That's long distance real estate investing. 43, your core 4. Another thing that was coined by David Green, I believe. And this is basically your team when you're buying real estate that is going to represent your interest and help you be successful. Okay, so this is typically going to be a real estate agent or broker, unless you are your own. This is going to be your property manager, unless you're self-managing. This is going to be your lender that you're working with to help you get the best loans, whether that's a broker or a credit union or bank, to fund your deals. And lastly, it's going to be your contractors or general contractor if you're doing renovations or maintenance on properties. That is going to make up the 4 people of your core 4 that are most commonly needed in all real estate transactions. 44, value add. So when we talk about value add, that is the way we add value to a property through appreciation by force. There's a few ways we can do that. We can raise the income of a property, like raise rents up to market rates. We can reduce expenses. So, let's say you have a bunch of leaking water lines and your water bill's $2,000 a month and you reduce it down to $500 a month, which is what it should be. Well, you just save $1,500 a month on your NOI and add that back to your NOI. Or renovating the property. So when I say value add, most often what I'm personally doing is I'm doing massive renovations on properties that are in really poor condition, or I'm doing full cosmetic renovations. So I'm adding value by creating a better product for tenants that ultimately will lead to increased income and usually reduced expenses as well, but mainly through renovations. 45, appreciation. Similar to what we just talked about. When you're adding or increasing the value of a property over time. Now, oftentimes appreciation is used in the sense of market appreciation, just meaning that, like we've had the last 12 years in real estate, values in almost all areas have been increasing month over month, year over year. That's market appreciation. Simply the value of this property is increasing over time. But there's also ways to force appreciation, like we just mentioned, through value add, through increasing income, raising the NOI, or doing renovations and creating a better product. 46, BRRRR investing. This is a common term thrown around in the real estate game, but this stands for BRRR, buying, renovating, renting, refinancing, and repeating this process. So this is the type of investing I've been doing the last 6-7 years, where I am buying properties usually at a low, well under market price. I'm doing significant renovations. We often do foundations, structural, mechanical, electrical, plumbing, all of those things, of course, all the cosmetics. And then we are renting them out to the best tenants we can find. And then I am refinancing that property and pulling out all or most of my capital, and in some cases, all of my capital plus a profit, and continuing to cash flow after that. The purpose of this type of investing is to reduce the amount of capital you're leaving in your deals after they're refinanced, and allows you to scale your portfolio much quicker. That's why I focused on it so much the last 6 years. 47, neighborhood grading. This is another term you'll see in most real estate investing circles. You'll hear people call neighborhood grades A through D or A through F. Obviously, A being the best, F being the worst. Typically, what that should be based on is the school district ratings, good schools, bad schools, the crime rates, is it a low crime or high crime area, the median income levels, is the median income going to support the market rents that you're trying to obtain, or is it going to be much lower than that? So is it a low income or high income area? And to me, one of the most important factors that isn't discussed enough in this grading situation is the demand for that general area. Like, the highest demand areas should be the A and B type of areas in theory. Now, sometimes you have these neighborhoods that are gentrified and have this massive influx of demand, like the historically famous one here in Cincinnati is Over the Rhine, that was a low-income, high-crime neighborhood for like 30 years, 40 years, and then all of a sudden became like hipster central, where all of the young college kids wanted to move to after they graduated. So quickly these neighborhoods can transition. They're not stuck in whatever letter grade they may be given by the community. But when you hear people talk about neighborhood grades, that's generally what they're referring to. 48, lead generation. This is talking about how are you generating leads for properties that are for sale. The common ways are through agents. You could work with wholesalers. You could be doing your own direct mail to sellers or direct marketing to sellers, cold calls, mailing. You could do SEO, lead generation, or work with other wholesalers. But typically you're generating leads that are either on or off market, which is what we're about to cover. 49, on market leads. Okay, this is properties that are typically listed with an agent or a broker on the MLS. So the multiple listing service that's syndicated to Zillow and all the other real estate websites, when you see the properties on there or even LoopNet, anywhere online, they're typically listed for sale. So that's on market leads or on market listings. Off market, these are ones that are either marketed by an agent or a wholesaler or being sold directly from a seller for sale by owner or otherwise, that are not listed on the MLS. So that's what, when you hear someone talk about off market leads, that's what they're referring to. Honestly, in this day and age, there's so much marketing that's done on off market leads that you're not really getting the deep discounts that you were getting 3, 5, 10 years ago on off market leads. They've kind of really meshed, and there's not a whole lot of difference in those. Number 51, wholesaling. So this is typically when you see someone marketing a contract for assignment or double closing, meaning a wholesaler buys and then resells a property, and they are hopefully getting these properties at a discount and selling them to end buyers or investors at a discount under market value, but they're not necessarily doing anything to the property. Sometimes they just get a contract, they assign it to an end buyer, and they make a fee in the middle, or they close on it and resell it to an end buyer. Again, they're not even really owning the property for more than minutes or days. They're not renovating it. They're not doing a whole lot of work with it. They're just kind of buying it at a discount and selling it higher, and that's how they make their profit. And the last one for today, number 52, a pocket listing. This is a kind of like wholesaling, but it's basically an agent who has a seller client who they know wants to sell their property but has not formally signed a listing agreement, or if they've signed a listing agreement, they haven't yet listed it on the MLS or publicly marketed it. So a lot of times what will happen is these agents will wheel and deal these pocket listings to other agents that they are friends with or network with, or that are in their office or within their brokerage. And a lot of times these are sold before they ever hit the public market. So these are technically like off-market deals, but they are listed with a real estate agent representing the seller. And a lot of times you'll hear these called pocket listings if you hear that term. All right, guys, thank you so much for watching part 2 of our real estate vocabulary that you must know. If you guys want me to cover more in a part 3, please leave me comments. If you have any other terms you're curious about, I'm happy to give a detailed discussion on those topics. Again, the entire vocabulary list is linked in the video below. If you want to check it out, it's free. There's just a link you can view with all the definitions that I discussed in part 1 and part 2. Again, guys, if you have learned anything from this video, if you're enjoying these videos, please like, comment, and give us a follow or a subscription. And I will see you guys on the next one. Thanks again.